Chị Vân nghĩ là có cần cái gì nữa không?
Khiếp, sao thì phát xỉ từ 0 đến 70 à? Dã man.
Đây là cái cách hoạt động của cái CSAT và ICS.
Okay. So good evening, everyone. At the end of the week for you, Friday evening, but you are still working from home. So let's start with the session 4. So let's course of financial analysis, is segmented into 5 sessions. And we had already 3 sessions. The session 4 is today, and the last one, session 5, will take place tomorrow afternoon for you in Vietnam. So I will use a few new slides which are dedicated to session 4, but also part of session 3 slides, which I didn't use yesterday. So first, let's go through the 3 first slides, which are called MEBF 18, session 4, and then move back to session 3 on the returns before moving to the debt analysis, debt capacity, and coming back with the operations analysis to MEBF 18 slides. So the goal of the session today is to move on ratio analysis, at least more on ratio analysis. We went through liquidity, solvency, and just started saying a few words on returns. So we have to go into the detail of the return analysis before moving into the debt and leverage analysis and valuation and the questions based on operating working capital. A second element I want to introduce in the session is a DuPont analysis, which is a kind of more advanced application of the ratio analysis. It's a kind of bridge between the classical ratio analysis and financial policy, what we will go through in one of the next courses. And then, if I have time, I will introduce cash flow on an exercise here, and we will move into cash flow tables in session 5. So this is what I want, this is the main goals. Now, if I go into the details to be more clear and in order to get some kind of direction, on the second slide, and I hope you see the slide. If you don't see the slide, just tell me you don't see the slide. It's MEBF 18, sessions 1 to 3. It's a summary of the topics we went through in these last sessions. We had first presentation of financial analysis in general and financial analysis methodology. Then we moved to balance sheet, and we explain why and how we need and we use a kind of standard format of the balance sheet. We went through the main equilibriums with a presentation of the equilibriums and an exercise. Then we moved in session 2 to the income statement with the different presentations of income statement, in particular the US based and the European based, introduction in IFRS. Point 5, we went through values, book, market, and a few words also on replacement values. 6, we try to show and underline the differences between the goals of accounting managers or accounting experts and finance experts or CFOs, and how we connect both approaches, particularly in financial analysis. 7 went to market and book value exercise yesterday, and we said a few words on the price earning, stability, differences between firms,
Excuse me,
connection with growth
Excuse me,
rates,
sir.
and, yeah.
I think we are seeing the screen of file yesterday. It's not the slide you are trying to share it with us now.
Is it still the same?
We are seeing the slide for session 3 only, the first page of the session 3, sir. It's not the slide for today yet.
Okay, so I try to do better. I just don't know why. And now?
Professor, it's still the same. This is the first slide for financial analysis, MEBF 18, section 3, and have 3 content from income statement to ratio analysis.
And now?
Now this is financial analysis, MEBF 18, section 4.
Oh, great, great.
Yeah.
Thank you. Thank you for your question anyway. Okay, so what I try to show you, I use only 3 slides at the beginning on session 4. Main goal here, it's more on ratio analysis. I want to go through all the different presentations and try to make a summary and explain how to use them. Second, to extend this ratio analysis using a method which is called as the Dupont analysis. I will explain you why it's called Dupont. And I will try to explain what the DuPont analysis brings, because this method is using ratios, but it is also a bridge between the classical financial analysis and the design and explanations of financial policy in a firm. 3, we will move to cash flows, but here it will be just an introduction to cash flow. Cash flows analysis will be mainly part of the presentation in session 5 tomorrow. Just to come back to what we did before, here, in order to get the structure of this presentation, so the course, that's the main topic we went through up to now. First, in session 1, some presentation of financial analysis and also of how to design, develop financial analysis methodology. The second point was on balance sheet, how to move from different presentations of balance sheet to some kind of standard presentation which allows calculation. 3, it was on the main equilibriums, not working capital, operating working capital, cash management, T, as we said here. Then the static analysis, the dynamic analysis, and a few ratios. During session 2, we studied the different presentations of income statements, mainly 2 of them, and the value. After that, we had also discussion on book, market, and replacement values, which is one of the most interesting points. We went to an analysis of the differences between accounting and finance, and how to manage these differences in financial analysis, which is somewhere between. And yesterday also we went through market to book value considerations, ratios, and PE and payout ratio. And we started the ratio analysis with a few slides on liquidity and solvency ratios, covering and rating. And my last slide yesterday evening was on returns. It was the introduction of returns analysis using ratios. That's what we did. If now I move to my third slide here, this is the list of the following topics. We are back, of course, on the content on session 3. That's what we did. Now we have to study operational return, investment returns, shareholder returns, valuation returns, financial debts and leverage, debt capacity. I wish to go through a few questions also. And we will move to the operating working capital ratios and exercise, the DuPont analysis, and a few words on cash flow, which will be a transition with the next session. This is what I would like to try to do. Probably I will not have enough time, and part of the topics will be studied in session 5. So this was my presentation for today. Now I want to move back, and I hope it will not be too difficult, to the preceding presentation. Now you tell me if you have again. That's it here. You should now see on your screen Financial Analysis, MEBF 18, session 3. Is that correct? Is it what you read?
Yes, sir.
Yes? Okay, great. So this is what we did yesterday. We studied on that yesterday. And we were somewhere here. That's it. This was the last slide I used yesterday evening. Okay. And I said about returns, there is no one return. There is no unique return. We have several returns. And that's the complexity of the question. We have a return on the operation themselves, which are based on the sales level, sales being used without VAT in these cases. We have questions and measures and tools to deal with return on the investments of the firm. We have also return for shareholders. That's the three main questions and ideas. Okay. One of the problems we have, is that we are able to measure. We are able to measure some returns, but we are unable to aggregate all these returns into one measure. This is what is written here, 1.2. So that means at the time we write the analysis, we have to take into account different measures and to integrate them into the diagnosis. Third point here, returns measures include book data and market data. Be very careful. You can use both of them, but when you make a calculation, you have to be very careful to the homogeneity of calculation. It means if you divide A by B, you can use A book value, but B should be book value. If it is C and D, C can be market value and D market value, but not C market value and D book value. Homogeneity is one of the rules. This rule of homogeneity exists also for VAT. You cannot divide a number without VAT by a number including VAT, or the contrary, the opposite. You have to divide, a number without VAT by a number without VAT, or a number including VAT by a number including VAT. And to come back to one topic I went through yesterday, be very careful when you use data coming from different periods together. Because when there is nearly no inflation, it means economic value, it's about the same. But when you have a 10% inflation a year, and you integrate in a calculation on investment in a ratio, data coming from 2016 and the data from 2020, it is clearly the same number doesn't have the same value. So there is also a problem of homogeneity. So homogeneity has different question. Inflation, that's clear. VAT also, which is important, an important one, and other questions of homogeneity. So now let's move to operational returns, operational ratios. You will find most of these ratios in chapter 2 in Berg and DiMarzo, And if you go also to my financial analysis course, we wrote with my colleague, Michael Troger, which is a big 107 slides you'll find in the documents I sent you. You will find more details on this first presentation. So operational return, is generally measured by ratios with a relation between a margin you find in the income statements and the level of sales without taxes. So after that, the only question you can raise is what are most frequently used. Yeah. So there is a list on that slide. There is a list, and you can see that first, in the US-based terms, we have a gross margin, which is a gross profit. This is something you know in your accounting system, divided by sales, which is used mainly and very important for commercial companies, So this is the first one, less important for industry. You have got the operating income ratio, which is a connection or division of the operating income by sales, or the EBITDA by sales. You find the same results, of course. On 4, you will use also the EBIT divided by sales. Again, sales without VAT. And for bottom of last line on the income statement, the net profit margin, which is net income or net earnings, divided by sales. Another one is used in our system, which includes the added value margin, and it is the added value divided by sales. But that's what you will find, And if you say what is the most important one, I don't have any clear answer. What I would say is that the number 3 and the number 5, if you look all the method of financial analysis used everywhere over the world, are probably the more frequent in the analysis. And it is understandable because net earnings to sales, it's clearly a relation between what is left at the end of the analysis, what is then on the bottom line, to the level of sales. And the second one, EBITDA divided by sales, it's a relation, percentage of what is left, after taking all the expenses, but the expenses related to financial policy, to relations with the shareholders, to taxes, and also to specific mechanisms which are not connected to production, which are depreciation and amortization. So this is very often used, and we will see also in evaluation course that today, when you use multiples, EBITDA is more used than net earnings, just because it gives a good idea of the real margin of the operations. So net earnings on sales, EBITDA on sales are the two leaders, I would say, in the list of ratios which try to give some ideas of the return of the operations. Just a few words on gross profit. Why is it so important for commercial trading companies? Because generally, gross profit is is very small, to sales is very small. Because if you take what we call in national accounting, production and consumption, yeah, and you deduct consumption from production, you get something very often around 10%. But the fact you have 8% or 11% is a great difference. You know, it's a difference by 30%, and beats your capacity to pay wages, or capacity to keep net earnings sufficient for shareholders is a result of this first result, which is a percentage of raw profits in sales. That's just what I wanted to say you here. It's very simple, in fact. Now, let's move to a second category. And the second category here on returns is return on investment and assets, ratios integrating investments and assets. So we find different categories of ratios here, and organize the slide around 5 points. You know, first it is the asset turnover. Asset turnover is something interesting because, you know, it means what is in fact a kind of multiplier of total assets you find in sales. Are you able, as a manager of a firm, you know, to use efficiently your assets? It is clear that if you are able to increase the level of sales with the same level of the total assets, it means that you are more efficient in the use of total assets. So turnover should be high, and the higher the turnover, the better at the end the performance of a firm. It means if you have your factories working on a 7 months a year, that means that the use of your set is not optimal. Perhaps you have constrained, but because you don't get the raw materials for a few months, because it's a product, the final product is sold only during the summer, and so on. But anyway, you have to try to improve the turnover and to increase the turnover. Now, we're trying to calculate a return on a set. The first way to do that is to take the net income plus the interest and to divide by the book value of a set. You see, we have several ways to do that. Okay, this is what is recommended in Burke and DiMarzo. Another way is to calculate the return on investment on invested capital, which is more common in many textbooks, and which is the EBIT with after tax, in fact, divided by the book value of equity plus net debt. And you have 2 other formulas which are easier perhaps to manage. The first one being the comparison between the EBITDA we just mentioned, and which is the true result of the production consumption relation divided by the total gross assets. It means the assets in book value before depreciation or amortization, plus something which is really connected, which is the operating working capital. Because you know, if you have a factory, the equipment, you know, if you want to produce, sell, you need to have inventories, just because you need some raw materials, some final products to deliver to the customer when they come to your distribution network, to your shop. And you try at the same time to obtain credits from the state tax administration, from providers, and from your staff. So this is another way which is very popular now. EBITDA divided by total gross assets at book value, and assets before depreciation, gross, not net. And you understand also this ratio is homogeneous in terms of depreciation and amortization. EBITDA, of course, is before depreciation and amortization, and total gross assets is also homogeneous with the first element in terms of depreciation and amortization. You find another ratio in point 5, which is exactly the same, but after depreciation and amortization. And more we calculate both. It gives us a good idea of what is using only one ratio, the return on the assets of the investment as they are integrated into the balance sheet. So that's the kind of ratio you will find. We have evolutions in the traditions, in the presentations of the financial analysis, and everyone is used in other calculation. You will see that in Dupont analysis it is used to explain the return on equity, ROI is part of the ROE, but it is less used now on simple financial analysis, where more and more analysis where number 4 and number 5 are used. So this is just what I wanted to show you here. It's very simple, but I hope it is clear for you. Now we have a problem of shareholders. We have a problem of shareholders, and we have really two different ways to analyze return for shareholder. If you ask a shareholder what is waiting from you have two different speech. The first one is based on accounting and traditional financial analysis. And if the shareholder has a knowledge in finance and financial analysis, more specifically, he would say, okay, I'm interested in the relation between the net income, net earnings, because net income and net earnings in fact belong to the shareholders, and they will decide what to do with the net income, net earnings at the annual meeting. That's what we explained yesterday. And I want to compare this net earning, net income to total equity. Okay, so this is the first practice, the first understanding of what is return per share. But there's still a question there. And the question is, do we have to use the book value of equity or the market value of equity? You will see what we do generally when you take an exercise. No, it's not your case. We take the book value because very often we don't have the market value. We know market value in two cases only. The first one being the case of a firm listed on the stock market, and the second one, if we were part, or if we have information on a recent acquisition or sale where the bidder at the target had to calculate the market value to find price. But in all the other cases, the only simple information you get is the book value. But you understand, because we said a few words on that, also on market value to book value. But in some cases, it's not an important question to choose the book value or the market value, because market value to book value ratio is close to 1. But some other cases, when it is 0.4 or when it is 3 or 4, of course, this choice has consequences. So for the shareholders, using the traditional approach of the textbook, which is clearly net earnings on net income divided by total equity, he will choose in favor of number 1 here in most of the cases, just because he has got the book value of equity, but he doesn't know the market value. For firms clearly listed on the market, generally we move to net income or net earnings divided by market value equity, which is more true. Can give you a better data at the end of the calculation. Another way to have a look, it is okay, my shareholder, he doesn't know in many cases about financial analysis. What he knows is that he was interested by the firm. He has a feeling, it was more a feeling than anything else, but this firm will perform very well in the next future. And he decided to invest $100 in one share. And what he's looking for, he's looking to what happened to this $100. And he's thinking in terms of cash, not of balance sheet, of ratio, of financial analysis. He says, okay, I invested 100 in January. We are now in December, okay? 12 or 11 months after, by the end of the year, I want to know what is my performance. And he will say, okay, if I want to find some kind of proxy of my performance, I will compare, the dividends I got plus the increase in share price. And I will compare these two data, to the total of these two data, to the investment. If I had invested 100 and I had $100 and I had $5 dividend, and now I have an increase, which is $8 with the price of a share. It's 8 plus 5, which is 13, divided by 100. I have a 13% performance. That's my result. And if I sell my share today, I will get 13 plus the 100. It means 113 in cash in my account instead of 100 at the beginning of the year. So many, I would say a large part, this is what these surveys show, that a large part, majority of the individual shareholder, they analyze the return on equity with this cash approach. On the contrary, the financial analysts, generally they use number 1 and number 2, which means the comparison between the net earnings and net income divided by the book value of market value of equity when they have some knowledge of a market value. Okay. Generally, also, if you come back to my shareholder, looking for cash performance is much more interested by 0.4 than 0.3, just because he doesn't know what is book value. I know what is market value. Market value is what is paid, what he paid in January, and what he will get if he resell the share at the end of the year. So it's mainly 0.4. It's mainly 0.4. Don't forget also, as in both cases, you have to integrate the tax situation of a shareholder. It means what about the tax rate on the increase in price? What about the tax policy on dividends? You know, no tax, or 5%, or 30%, or is it included into the personal income, and the tax rate will be generally, in that case, the marginal tax rate applicable to the investor in the country where he or she pays taxes. So you have to take into account all of these elements, because there are potential reduction of the return. So remember here, we have two different ways to analyze the returns of shareholders. The first one is based on the accounts. It's classical financial analysis. And the second one is based on cash. And on the third element is that all these calculations, 1 to 4 here, are presented without taking into account the tax policy at the personal, individual, family level. Okay. Generally, most of the cases, what you will find in financial analysis is net income or net earnings divided by the book value of equity, because it is more simple. Financial analysts don't have the data for market value. However, in a case where a firm is listed, we move in general to market value, which is, of course, brings you a better, more feasible result. For the individual shareholder, it is clear that he will use only market value. He doesn't know what is the book value. It's not his problem. So he will use number 4. Okay. That's what we have. Now I move to slide number 12. Okay. So when you are dealing with returns for shareholder, you are very close to something which is a bit different, which is what we call valuation ratios. Okay. They are kind of byproduct of the return analysis. But they use also market and book values. So be careful again to the homogeneity. Homogeneity in terms of market and book, homogeneity in terms of taxes, homogeneity in terms of inflation, you find always the same problem. So first, of course, we have a market value of equity to the book value of equity, which is, we know very well. I don't come back on that point, but it is very central to understand how the company is valued by the markets. And we know that this ratio, value ratio, is connected to potential growth and return of a company. So second one, remember that also, it's a price earning ratio. When you say a few words on that again, yesterday, it is a share price divided by net earnings per share, or the firm market value divided by the total net earnings of the firm, or net income. Okay, and we know that if you consider the price earning ratio of a firm, and if you compare this price earning ratio from one period to the other, generally it's not stable. And the non-stability is explained, of course, by the situation of the firm by its performance, but also by outside element like the level of interest rate, like the level of growth of the economy as a whole. Okay. But we know also, of course, that averages, if you make a comparison to the average of the economic sector firm, if you make the comparison of its P to the average, it gives you an information of interest, but be careful because an average is not always a good benchmark. You know, if you are in a sector which is under depression, which is in a very difficult situation like the airlines today, it's not because your PE is 5% above the average of the sector that you show good performance. So the situation of the economic sector is also an interesting part. So it's important to find PER, but at the end, it's not so easy to interpret, or at least you have to be very careful when you make your calculation, when you make your comparison over time, when you make also your comparison to averages of firms in an economic sector. You will see also the valuation, another point that we deal with mainly in the valuation, but also in the M&A course, which are the enterprise value ratios. It means a calculation, you know, of ratios which are the enterprise value divided by EBIT or EBITDA, or sales, I can do it both. We can calculate the enterprise value as the market value of equity plus the market value of financial debt. That means, in fact, now the ratio here is market value of equity and not book value plus the market value of financial debts. This is what we call the enterprise value. And you divide this by the EBIT or the EBITDA or the sales level. You will find the three ratios used in financial analysis. Well, now we'll come back on that ratio later. It's very often used in valuation processes. So number 13, we start with something different here. Means we went through operations, we went through shareholders, these valuation ratios, which are very close to shareholders. And we have to give a brief survey on financial debts and leverage ratios. It is interesting because it is very central. It is of interest also, you will see that, because it will bring us progressively to the measure or try the proxy of the calculation of what we call debt capacity or flexibility. And flexibility, if you have a look in some textbooks, you know, it's become today a concept, a very essential concept in financial analysis. It's not, curiously, it's not integrated into a Burke and DeMarzo book, but you know, it's several textbooks and looked to in the last month. It is more and more important, No. So let's come back on that. So let's start with debt equity ratio. we have several presentations. You will find different presentations in different financial analysis methodology or in different countries. But it is also moving. The first one, which was a very classical one. If you came back 15 years ago, I would say it will be the dominant one. It is point one you find here. The total debts divided by book or market value of equity. Clearly, 15 years ago, it was, total debts divided by book value of equity. It means it's not very difficult. You have a look to your balance sheet. What do you have on the right side? You have two categories. You have what we call liabilities. What is liability? It's debts. And you have equity. So you take all the debts. You don't care if they are long-term, medium-term, short-term, promotional, financial, and so on. And you divide by the value of equity. You find the balance sheet. It means book value. Book value. So it is very short. Total debts divided by book value of equity. Okay. Progressively, market value were introduced. And at the same time, it was more and more clear for analysts and academics also that operational debt and financial debt were something completely different. So if you have a look to number two, you find now not total debts, but total financial debt. It means if you come back to a presentation, the startup presentation I introduced, it is the long and medium term financial debt plus the short term financial debt divided in the most simple case. That's what you will do with biotechnology. Book value of equity, or if I give you in that case the market to book value ratio, we will be able to calculate the market value of equity, and the ratio will become total financial debt divided by market value of equity. So, you are with something which is used very often right now. If you have a look to the US publication for the last 2, 3, 4 years, total financial debt divided by market value of equity is the dominant ratio which is used. Now you can have a third ratio, which is the debt, what we call the debt equity ratio, including only the long and medium term financial resources. And it is total long and medium term financial debt instead of total financial debt. It means you exclude now the short term financial debt and you divide it by the book of market value of equity. If you have a look to the European practice, and this is one difference between the US and Europe, the number one ratio used here is total long, medium term financial debt compared to total financial debt, including the short term financial debt in the US. And of course, it's moving also progressively when it is possible from book value to market value of equity. You will be able to make this calculation with the biotechnology case. Now, you find also another presentation, which is a very classical one. It was used in a large percentage of cases 10 or 15 years ago. We find less and less this ratio. Total debts, all debts financial and operational, long-term, medium-term, and short-term to total equity plus total debts. And we had a presentation also of this ratio, which is probably more adequate, which is total financial debt, not total debt, to total equity plus total financial debt. It means that we limit the analysis to the medium and short and long-term financial resources. So you have a kind of portfolio of ratio to measure exactly the same thing. To say, okay, does the level of debt acceptable? Does this level is acceptable for the firm? Does it create a problem? Or is it at the optimal level, not creating too much risk and improving the return? Just because we know, and we come back later on that, we know that the cost of equity is always higher than the cost of debt. It means if you increase your level of financial debt without crossing, the limits which are accepted, if you do that, you have a better performance than if you use only a few percent of your capacity to obtain debt. This is a question of WACC. You come back to Olivier Rosar's course, and we know that the net present value of a portfolio of investment of the firm is a function of the level with an average cost of capital. And if you increase the percentage of equity in your WACC, you have a higher WACC. If you increase the percentage of financial debt in your WACC calculations, you decrease the level of WACC. Okay? So you understand, of course, that it's much better to increase the level of WACC if this decision doesn't create a too risky and not acceptable situation of risk for the banks, for shareholders, for other stakeholders. Let's say, to summarize all that, if I say, in a very classical case, if you are a kind of modern analyst today, what do you do generally? You take the total long medium-term financial debt divided by the book value of equity, which is number 3. For firm listed on the market, you just modify this ratio and you use the market value of equity with the long and medium-term financial debts. That's what you do. Okay. We show differences between countries, mainly between the European countries and America. Okay. But it's a limited, very limited difference at the moment. Okay. This is a ratio which is also interesting. This number 3 we use, because if you have a look, to the surveys made also with many bankers in the world, to the question, what is your limit? What do you accept, for total long and medium-term financial debt divided by the book value of equity? You find differences, but the convergence is around 1. It means the principle is very simple. No more financial debt than total equity. We, of course, have our methodology, but one of the principles is that we never lend to a firm more than the level of total equity brought by the shareholders. Of course, all principles, have exceptions. And the main exceptions is are the firms dealing with infrastructure. A good example is the freeways or motorways, you know. In many countries right now, a large part of the freeways or motorways are not free anymore. You find you have to pay tolls. You have to pay tolls. That means, you know, the potential future income of these motorways is non-risky, or whatever is risky is very limited. Motorway will not disappear, but all are there. Perhaps the price paid by the car driver will move up quickly or slowly, but at the end, you know, the cash obtained from the toll station will be in line with the debt repayment. So you find very often in that kind of project something like 85% of long and medium-term financial debt compared to the book value of equity. But this is a kind of exception. We have a long-term horizon, which is clear, identified with data, you know, generally bankers like this very much. So that's what I wanted to say on that slide. I move to the next one here. So you find also a group of ratio here, which is on the limit between the analysis of financial debt and the analysis of what we call leverage. Yeah? Very often we call them also multiplier. That's how they are called in Burke and Desmaisons. And in my presentation here, you will find 3 of them. The first one is debt to enterprise value ratio. It means it is a net debt divided by the enterprise value. You find an equity multiplier, which is in book value, total asset divided by book value of equity. And you find an equity multiplier on market value, enterprise value, divided by the market value of equity. Let's say they are not very used. They are used in very detailed analysis. They are not very used, or they are used also in when you are looking for valuation because you are in charge of finding the value of a firm for an acquisition, for merger, for something like that. You know? But that's not used in the classical financial analysis. Now we are coming back to something different. Not know why. Cash flow, which is we are on the limit here between financial debt, leverage, repayment capacity, you know, and debt capacity. First problem is the capacity, the repayment capacity, and repayment capacity. I don't know what is 30 here. Just eliminate that. Is measured by the relation between the long and medium-term financial debt, book value divided by the cash flow. You know, the idea is very clear. When you use measures to identify if debt is risky, if there is still a capacity to obtain new debt, we have two analyses. The first one is analysis of the structure of the right side of the balance sheet. And this is the basic comparison we saw in one of the preceding slides. Comparing the long and medium term financial debt to total equity, both being book value with this limit of 1. And the second one is the repayment capacity. And when you have that, how do you pay? How do you pay? You pay with the value you create. And what is the value you create in financial analysis? It is a cash flow. So the long and medium term financial debt, book value, because you pay the book value, you don't pay the market value as a CFO, is compared to the level of the cash flow available. And the idea here is that, of course, we have classical limits. We said 1 for the ratio long and medium term financial debt compared to total equity, book value, and the limit is 1. And here, long and medium term financial debt to cash flow, book value also, and the limit is 4. It means, what does it mean? It means your long and medium term financial debt should not be more than 4 times the present cash flow. Between 4 years of cash flows at the present level is the limit, accepted or acceptable for your long and medium term financial debt. And both criteria should be met. So it means if you want to get more debt, if you want to have new debt capacity, you need that these two constraints are met, are satisfied. So that's the reason why we use, and this is point 2 here, these two ratios, to measure the debt capacity of a firm. One being the debt equity ratio, you see that here, but just what I explained, which should be under 1, and the second one being the repayment capacity coming from the comparison of the cash flow at the present time and the accumulated long and medium term financial debt. Okay. So this is very basic in financial policy, very basic. So this is a very short, small example. We go further later with biotechnology, just to give you some kind of clear idea. Let's say we have a company, which is a company here. The total equity is 100. Long and medium-term financial debt is equal to 60. And cash flow has disappeared. It was a 30. I'm sorry, I don't know what's happened. It's equal to 30. Long and medium-term debt, the first one, first calculation, structure calculation, divided by total equity is equal to what? Is equal to 60 of financial debt divided by the total equity, which is 60, which is 100. It means this ratio is equal to 60%. If you don't accept more long and medium term financial debt than total equity, that means you find the capacity, that capacity according to the analysis of the financial structure, which is equal to 40, the difference between 100 and 60. That's what you find. So that means that debt capacity here is equal to 40. Okay. But to find the global debt capacity, you have to meet this limit of 1 here for the structure. But at the same time, you have to check what can be repaid using the cash flow variable, the last available cash flow. And what you do, it's a calculation I mentioned preceding slide, of a long and medium term debt divided by the cash flow, which is 60 divided by 30. 60 is the level of debt, 30 is the level of the cash flow. It's equal to 2. What is it? It is 2 years. Well, not in percentages now, we are in years. We have years. We need 2 years of cash flow at the present level to pay back the long and medium term debt, financial debt accumulated. Okay. So now, for the repayment constraint, what is the debt capacity? Total debt capacity is equal to the level of the cash flow, 30 multiplied by 4 years. 30 multiplied by 4, but what you see here is equal to 120. And we have 120 minus the present level of debt. That means if you have a debt capacity, total debt capacity 120, and you already use 60, you have still a possibility to borrow 60. So the debt capacity, according to this constraint, is 60. That means you have a constraint here. The debt capacity of 40 using the analysis of financial structure, and the debt capacity of 60 if you use the repayment approach. And of course, that's what I tried to explain in the preceding slide, both constraints should be satisfied. If both constraints should be satisfied, that means that the tighter one is the true one. If you have 40 and 60, of course, it is 40, which is the global debt capacity. The firm as a whole has a 40 possibility to ask for new loans, no more than that. That means if you have a project of investment, and for example, the project of investment is for, let's say, 100 again, if you want to use new equity and new loans to finance your project, you cannot use more than the debt capacity, which is 40. So that means you need a mix between equity issues and the debt capacity. I will come back on that with more complex examples. Yeah, what does it mean in terms of financial policy? In that case, the constraint which is tight is the first one. The debt capacity of 40 is coming from the structure of the right side of the balance sheet. It's not coming from the cash situation or the capacity to produce cash necessary to pay back. That means we have a problem, which is the financial structure problem. We don't have here a return problem, a performance problem, a cash production problem. And when you have a debt capacity in terms of financial policy, what is the solution in general? It is to increase the equity level. Because if I increase the equity level, of course, to like 20, I bring 20 and more equity with a counterpart, which is cash. what will happen? My total equity will move from 100 to 120. And my ratio, will be improved. Of course, it will be 60 over 120, which is equal to 50%. And the new capacity, according to this structure approach, will be equal to the difference between both data, 60, 120, to be 60. That means the global debt capacity with this new hypothesis will be equal to 60, because both constraint, both analysis, structure, and we will bring a debt capacity of 60. So in that case, the solution, if you need to increase the debt capacity, is an equity issue. In other cases, it could be more complex. For example, I don't have the data here, and I show you the data to know. If we have a situation where constraint is not on the structure, but on the repayment, the only possibility, is to improve the cash flow, to increase the cash flow. How to increase the cash flow in the short term? It's very difficult. It's much more difficult, than to make an equity issue, small equity issue. How to do that? You can do it in the medium and long run, perhaps, it's not so sure. Increasing the level of sales, reducing the level of costs. It means creating a new financial business model with better operational performance. But it takes 1-2 years to do that. Okay. The other possibility, which is very often used by companies, is to say, okay, I need to increase my cash flow now for 2 years. The main possibility is to sell some assets. And you find many companies doing that. They have a constraint on the cash flow. The constraint is not financial structure. The constraint is on the second ratio here. They want to improve this ratio in order to have a less tighter constraint. They sell a few assets. But in that case, the answer is not to improve the financial structure, is not to make an equity issue, but it is, to make cash by redefining what we call the core business. You make an analysis of the core business, and you say, okay, among my activities, among my departments, subsidiaries, the countries I'm working in, some of them are very important, are really central in the core business. Some others are marginal. And if I sell, and if I a buyer for these countries, departments, subsidiaries, I will get cash. This will increase my cash flow for 1 or 2 years, and that will be enough to increase my debt capacity in terms of repayment. And perhaps for the long term, we have a program of improvement of the relation between the cost and the sales, and improvement of the performance, of the productivity, of the efficiency of the system. So in many cases, you can start with a kind of preparation of not only a financial policy, but an analysis of the core business. And generally that kind of analysis bring the concentration on the central part of the core business, the part which has a better performance, and which is also central in the future development of the firm. So that means that this analysis of debt capacity is not only a kind of calculation. At the beginning, it starts to be only calculation, two ratios, barrier, 1, 4 years, and so on. But in a few minutes, it becomes part of a strategic decision. It brings you. You are obliged to come back to your portfolio of activity, your strategy, to make decisions how to get cash and so on in the short term, and how to develop, my efficiency, my profitability, my resilience in the long term. Okay. So there is another example here I prepared, which is also a second example, which is in a few data, what I just tried to explain. Let's take the example of a firm with the same total equity, 100, long and medium term debt, 60, cash flow equal to 10. So cash flow is much lower than before. If you make the calculation, you still have for the first part, the same result. The structure analysis, long and medium term debt divided by total equity is still 60 divided by 100, 60%, and debt capacity according to this first analysis. Right side of the balance sheet structure is still 40. Do the same thing now with the payment analysis, and you compare the debt level to the cash flow, and you find 60 divided by the cash flow, which is 10, which is equal to 6 years. So the debt capacity for the second possibility, we are in the cash flow analysis here, payment analysis. The debt capacity is equal to 10 the cash flow multiplied by 4 years, which is equal to 40, minus the debt, which is 60, which means minus 20. So we have a debt level today, which is such that the debt capacity is negative. We have obtained through negotiation, perhaps, banker we know very well, a credit above the lines, above the limits. So it is clear there is no possibility to obtain new bonds. So we are in the situation, I explained a few minutes ago. There is no debt capacity because the returns, the performance, the production of cash flow is not sufficient. And we need, in that case, to increase the cash flow level. It's not a question of equity issue, it's a question of improvement of the cash flow. And perhaps if they are available, we can sell part of the assets, marginal assets, marginal activities, productions, cash. It will solve the problem in the short term, and then we have to improve the performance, increase the sales, reduce the costs, have a better use of the assets, the investments, in order to produce more cash flow in the medium and long term. This is this case. So you have two basic main cases here with small examples. This is what I just wanted to show you. Yes, at the end of the presentation, I had for you also a few elements, a few questions. Perhaps you can have a look to that. It will give you, it will train you for the final exam. So we start with the first slide. So we went through debt analysis, debt capacity, flexibility, returns, and shareholders ratios. And before yesterday, we went through liquidity and solvency. That means at that point, we can do more, but it will be mainly on the operating working capital elements of the balance sheet. So let's have a look to these questions, which are on these two slides. The first one was the following. The role of trend analysis is to look at the past, to assess the present situation, and to forecast the future. Financial analysts should look at performance over several years. What are the drawbacks of this method? Okay. It's easy to find. What do we do? We use the last three balance sheet and income statements. So that means today, perhaps 2020, 2019, 2018, if we already get 2020. And we expect to find a good forecast for 2021, 22, 23. Do you think that the data of 2018, 17, 19 will be the best data to forecast cash flow, the sales, and so on, for 2022-23? So that's always the same question. We use what we have. And our resource in terms of data, in many cases, is only the resource of past period. So there's something wrong. But this is what we do, because we don't have any, in many cases, we don't have any more data. Okay. What do we do in order to improve this approach? Several things. The first one, we use averages. It means this is the idea of trend. What is the trend of each ratio according to the last accounts? So we can calculate one of them and make the average between the past 3 years. You can make a forecast on 2021. You add this calculation on 2021 with the 3 preceding one, and you have some kind of average, and use the average. Okay. Or what you do is you have these 4 calculations, last 3 years, the present forecast for 2021, and you use what we call the trend. It means, you have a look to what is the changes. Is this ratio going up? Is it going down? Is it stable? And you make a kind of forecast, but it's a kind to you follow a trend, and you create the data for 2022-23 according to the trend of the last 4 years. It's like when you work with linear regression. Same kind of situation. You could have done that using linear regression, and you know very well linear regression after the statistical course, you have a few data, but three is not enough. But if you have 5 or 6, you make a regression, you calculate the slope of a line, and the slope of a line allows you to draw on the paper the new part of the line for the years after 2021, and you just read the numbers on the line. This is how to use the trend using your regression analysis systems. Okay. One of the drawbacks also is that you can find in these data, or in the 2021, for example, abnormal situations, either because one year was very positive, I would say, for performance. In many countries, 2019 was a very good year. And if you integrate 2019, 2018 with equal weight 2020 and use this as an average to find the slope of a line, the regression, and so on, that means you don't integrate probably, sufficiently the consequences of the pandemic. So this is very difficult to do that and to use trend analysis in time of discontinuity. And the crisis like pandemic is a discontinuity in the evolution of the economy and of course of the financial situation of the firms. So that means that trend analysis, using the weight, using the regression line, this is okay when you have recurrent growth rate, and the economy is stable. If you have some kind of discontinuity, it becomes very difficult to use trend analysis. And you have to start again designing the income statement for 2 or 3 next period, point by point. What could be the level of sales first? After that, what are the evolution in terms of costs, main costs, wages, mainly, raw materials, that kind of thing. So you have to redesign, rebuild the income statement point by point to find the net earnings, the cash flows, what you need to make your measures. So trend analysis is based on the past. Very often we use weights. Sometimes we use regression analysis to try to find data which are missing for next future data. That's acceptable as long as we have a stable economy, constant growth, let's say. When you have some kind of discontinuity and you live in time of discontinuity, it's not acceptable. That means you start again with the income statement of future years, and you have to design point by point the income statement of the year if you want, to have the basic data to make a financial analysis. That's what we can say here. Second question here, it's on comparative analysis. Comparative analysis, we call it very often benchmark analysis. A company which is very similar to yours is a good benchmark. Consists in comparing a company key profit indicators with those typical of companies operating in the same sector of activity in the same country. Explain and discuss. That's, of course, that's okay. I told you I've been working for Dana for years, and every morning, one of the first things we did was to have a look to all the news, information of main competitor, and particularly on the leader of the sector, Nestlé. Okay? It was the benchmark of the industry, of dairy products industry. Okay? But it was easy because a yogurt is a yogurt. You can put strawberry, you can put cherries inside, but it's still a yogurt. And not many differences. Yeah. So it's a kind of nearly standardized industry. But the problem, is for industries where there is nearly no centralization. When you have a look, for example, today, it's a very good example to biotechnology, and you want to make a comparison of a biotechnology firm to others, very often there is no comparison. Or you can find comparison, but the closest firm to a biotechnology firm you want to analyze show important differences. Not exactly the same research process. They are not dealing with the same kind of potential illness or pandemic. They don't use the same technique and so on. Okay, they are biotechnology firms, but they are quite different, so you have to be very careful using the comparisons. It was also the case we found when we wanted to compare, these large information system firms, very well, when they were analyzed in order to be valued before the IPO on the market. And in most of the cases, there was no comparison. When Microsoft was introduced to the market, there was no other company close in its model. That was the same problem with Apple. So comparative analysis is limited in that kind of situation when you have a new business model, something which is completely different from the other firms existing in the world markets. And you have to measure the evolutions, another way. The first one, of course, is to compare 1 year to the preceding year, but it doesn't say if it is a good performance or a bad performance in absolute value. It shows you if it is in relative comparison, relative value, a good or bad performance, which is not so bad, but it's not enough, So it's very, very difficult to explain. A comparative analysis is very useful in standardized sector. The full industry is full of firms. There are thousands and thousands of firms in the world, And in any kind of food production, you always find some kind of comparison. In industry with a limited number of firms, when the economic sector is new, it's very difficult to use comparative analysis when you need them, either to measure performance or to start a financial analysis in order afterwards to find the value, for example, for an IPO. Okay. Third question. The return for shareholders can be calculated using accounting and market-based formula. Do the financial analysts obtain the same results and conclusion using different formulas? Explain and discuss. Yes, it is true. Return for shareholders, and we know that performance anyway can be using accounting or market-based formula. That's what we saw with the example of ratio we studied. Do now financial analysts obtain the same results? They obtain the same results if the book values and the market values are very close. If total equity value, book value, market value are very close, it means if market value to book value ratio is close to 1, the results will be very close. But when the market value to book ratio is either very low, banks today, or very high, luxury, information system, biotechnology, results are completely different. So it depends what you are looking for. Are you interested, by measure of risk on the right side of the balance sheet because you want to make a forecast of potential debt capacity, and in that case you use book value? Or are you interested by the question raised by shareholders on their returns, and they are generally interested by cash? And financial analysts should use market values. So, two cases. Either the market value and book value are very close, and there is no problem, or they are very different, and you have to decide to use the book value or market value according to the goal and the players involved. If the goal is to measure debt capacity, you use book value. If the goal is to measure the market performance, you use market value. The return is market value. So this is what I wanted to show you here. These are classical questions. You have to think about that, It's much more important than to be able to calculate, one of a ratio. It's to understand what the question is, why do we use this ratio? Is what are the numbers we have to use the ratio? And after that, it's how can we interpret the ratio? Does the calculation, does the ratio bring to the analyst and to the analysis and to the diagnosis and recommendation an added value or not? That's the question. Okay, this is what I wanted to show you on this first category. So we are now here just before the last slide with a few more questions, and I think you can answer these questions very quickly. Perhaps it will be more difficult for the last one, but let's try to do that. For the first one, price earning ratio is not constant over time. Explain and discuss. We have already said a few words on that. We know that it is true. Even the average price earning ratio of a market is not constant over time. It depends on macroeconomic events of behavior. Interest rates first, because it's a very simple element. When the interest rate go up, many investors buy bonds because bonds are supposed to be less risky than shares. So what do we do? Well, what's happened? But you have more cash, more liquidity in the bond market, less liquidity, less cash on the stock market. that means that the stock market is going down and the price earning is going down. If on the contrary, when this is what's happened, for the last year, or about 1 year right now, if interest rates are going down, it's not the interest of investors to buy bonds. And they prefer to buy shares, even if shares are more risky. And immediately you find more and more liquidity coming on the stock market. Investors buying shares. And of course, the price of the shares are moving up. But at the same time, you don't have at least a short-term increase of the earnings, of the net earnings. So that means the price are going up because of the liquidity, because of the demand for share, and the net earnings is not going up, it's relatively stable. If P is going up quickly and his net earnings, the earnings are stable or going up very slowly, that means that your price earning is going up very quickly. So interest rate, is a first explanation. The second one, is about the vision of the potential investors in the economy, confidence. It's very, very central. One of the reasons why, the market are still going up, stock market, it means that we have more and more liquidity coming on the market. So is of course the explanation of the interest rate. But we have another explanation. It is the confidence in the evolution, the growth of the economy, because the investors think that in fact the pandemic is behind us. They say, okay, we have still problems, but we know how to manage that. And we will find a complete solution. It will take time. We know it will take time. But our forecast for 2022-23 is that, the growth of the economy will accelerate and the profits will also grow. So don't remember that the stock market is a kind of forecaster. They are designing scenarios, taking into account the scenarios on the future, and today the future scenario is very positive. So the consequence is that you have more liquidity going on the market, stock market, and the price earning is going up, prices are going up, net earnings are not going up slowly. So price earning ratio are going up. You can explain that also by what we call the risk premium. We do a study on that in valuation. What about the risk premium? The risk premium is going down. Risk premium was very high at the beginning of 2020, first and second term 2020. Now the risk premium is going down because the vision of the future is positive, even if it is not so positive today. So you have to understand very clearly these problems of price earning. The second question is, proxy of the financial capacity of the firm can be calculated using two ratios. Do these ratios include short-term debts and the equivalent debt of leasing contracts? Discussed. So we have spent time with that. You know that the most popular ratios today used to calculate debt capacity, the two ratios I went through, the two examples, don't include short-term debt. They take into account only non-current liabilities and equity. Okay. And This is the point we didn't go through, the equivalent date of leasing contracts. The answer is yes for operational contracts. And if you want that, I will come back in detail tomorrow on that point. So the answer is yes here. Okay. That's okay for question 2. So perhaps before moving to 3 and 4, let's have a short break right now. For you, it's something like nearly 5 to 9. Yeah. Let's say we're back at 5 past to start again with the next slide, the next question, and after that, by the other slides. Okay. Just 10 minutes break. Thank you.
Bởi vì tôi biết em chẳng tha thiết
Okay, so now let's please start again after this short break, and on this slide, which is the last 19, slide number 19 of session 3, I have just two questions to bring a few elements on. It is question 3 here. The market to book value ratio is a good proxy of the past potential growth rate of a company. Explain. It's just to, I don't know, to be sure that you remember what I said, market to book value ratio is a very central ratio in financial analysis. It's a good proxy, as it is written here, of potential growth and performance of a company. The main difference between the market and book value ratio being, in fact, the net present value of the future cash flow discounted, at the rate which is the cost of equity, right? That means it is the rate used, discount rate used by shareholders. It is not the WACC, it's the rate used by CFOs. Okay, that's one of the differences. And the market to book value ratio can be positive, the market to book ratio can be negative, depending on the economic sector, and be also perspective you got on the economy. Okay. Question 4 is a more complicated question, more complex question. A sufficient debt capacity level is a necessary condition to fulfill for financial managers to be able to finance an unexpected large acquisition or restructuration process. So this is something we'll go through in more details in the M&A course. But anyway, at that level and the financial analysis course, you have some kind of feeling on that. Why do we need that capacity? And why do we need to protect, to hedge this debt capacity? Just because today in the present economy, opportunities, investment in technology, and also potential acquisitions or merger or joint venture creations, they are very often not forecasted. We are in an uncertain, moving environment, and that means each firm should be ready, to be in line in terms of financial structure, financial policy of a future project, of investment, or of acquisition or merger or whatever it is, inside the firm or with other partners outside the firm, on the market, or by a negotiation. And that means the CFO should be ready to find the financial resources needed in a very short period of time. How to find these resources? The first possibility is to get the resources in the firm to get excess cash. But excess cash without no use is very costly, even if it is get some basic small interest, low interest in the bank. The second possibility is to have shareholders, but it is mainly in the case of families, family ownership, ready to bring very quickly the cash necessary. The third possibility is what you find here, is to develop debt capacity, and we know how to calculate them, a large debt capacity, in order, to be able to obtain the financial resources needed when you need them. But this debt capacity should be, negotiated, should be used to negotiate, potential loans with a bank. This is what we call multiple option facilities. It means you negotiate with a bank the possibility to get in 24, 48 hours large amount of cash. And of course, you pay for these options, and you pay when you use the options. So debt capacity is one of the three main possibilities to be ready to finance new operations, either new investment, for example, because the technology is moving very quickly, or acquisitions, joint ventures or mergers. Being excess of cash, but excess of cash is very costly. Being also the possibility to get the cash from the shareholders, and it is generally a case of family-owned firm. And the third one is this one, debt capacity, which is not used, which is kept carefully, and which is adjusted, prepared to be used with agreements, contract with banks, which integrate options of liquidity and sometimes other kind of options like currency options also. So this is what I wanted to do. We will go in more details during the following courses. So now I've finished with the two sets of questions, slide 18 and 19. I want to move to the other of the presentation, which is here. So I hope I will find the presentation. She's here. So you should have on the screen now MEBF 18, session 4. If you don't have MEBF 18 session 4, just tell me right now, no, in order I try to find, the process to present this set of slides. Do you see MEBF 18 session 4, please? Yes or no? Yes? So I believe it yes, because you don't answer. So remember what we do. We have been through 3 slides here already. And now I use slide number 4, which is operating working capital ratios, and it is the case of inventory. So remember, we move from liquidity to returns, from returns to shareholders, and to multiples. We moved after that to financial debt, leverage, debt capacity, a few questions already raised, and now we are with the last set of ratios on operating working capital. And in operating working capital, we have, of course, 3 main cases: inventory, receivables, and payables. That's correct. So if you don't see operating working capital ratios 1 inventory, just say no. I assume that all of you on the screen find this slide. So inventory, what kind of measure can we have? No. The first ratio we have is probably the most used ratio, which is not the ratio you find in the textbook, but is the ratio you find in many banking financial analysis, because it is very simple to calculate. Simplicity, is very often the criteria. And it is inventory level, the total inventory you find in the balance sheet, in percentage of the sales. To be more clear, it is total inventory as it is in your balance sheet on total sales. You find it first line of your income statement. All these numbers without VAT. Be very careful. Sometimes we get sales with VAT included. It is without VAT. But total inventory, there is no problem, because in the balance sheet, inventory is without any VAT. It is a percentage result. If you have, I don't know, inventory is 20, total sales is 100, you have 20%. It is 20% of sales. That means the value of the inventory as it is recorded in the balance sheet is equal to 20% of the sales level without VAT. Very often, you find, and in many countries, you find something which is in days. At the beginning, we don't understand why it is in days. You don't understand. Excuse me, it's wrong here again. So you just take the same number, total inventory and total sales, and you multiply by 365. The number of days in a year, all that without VAT, and you find an answer which is the level of inventory, not in percentage of total sales, but in terms of days of sales without VAT. For example, we have a result which is if you have, let's come back to my calculation, 20 for the inventory, total sales is 100, that's 20% multiplied by 365, which means 365 by 20%, it's 73. You will get, as a result, 73 days of sales without VAT. The inventory level as it is recorded in the balance sheet is equal to 73 days of sales without VAT. And very often, you know, when you are negotiating between firms or negotiating with banks, you know, the data which are presented are in days of sales, not in percentages. It's a kind of tradition of the financial world. So 2 percentages, but in fact, at the end, it is the same. Same conclusion. The third point here is inventory turnover. Inventory turnover. We had also already, you know, one data, one calculations on with turnover to obtain turnover. It was total sales. It was the turnover of a set. Total sales divided by total sets. Efficiency, it was the efficiency of the use of the sets. The idea is exactly the same. It is the total sale without VAT divided by inventory. With a certain level of inventory, for example, 20, what is the level of sales which can be obtained? If you say it is divided by 20, that means it is 5 times. It means, in fact, if you consider that the units inventory are sold and you buy again to your providers for material and you produce again, you replace 5 times in a year the total level of inventory. And of course, when it accelerates, it's much better because the cost of inventory decrease. The speed of replacement of an inventory is an element which explains a higher return or performance of a firm. You have to accelerate this. Be careful also to the comparison. If you have a look to Burke and DeMarzo again, you will see that he doesn't use total sales, but instead of total sales, he uses the cost of sales. So what about the replacement of cost of sales, of total sales by cost of sales? I would say first, it's much more simple to use total sales because total sales, you always get the data available. You get it with VAT, without VAT, there is no problem. Cost of sales, you know, in the American presentation, it's available. In the other presentation, you have to calculate it. And to calculate the total cost of sales, the only solution is to start with by the sale level. To say, for example, my total sale level without VAT is 100. I know my net earnings divided by sales is about 10%. So that means the cost of sales is 100 multiplied by 1 minus 0.1. So I have to recalculate to calculate a proxy of the cost of sales. Okay, it's something you can do, but it's a proxy. It's not the true value you can find in the US-based approach. So both are used, Even if today, I think, even in North America and Canada, for example, we use more inventory level in percentage of sales than in percentage of cost of sales. So, remember, we calculate the ratio of the total inventory. Total inventory means take into account the raw material, taking all the intermediate products, you take into account the final products, divided either by the total sale level or total cost of sales. You have different references, of course. And these ratios show a result which can be a percentage or a number of days. That's the two possibilities you have. Okay. Now, a slide which is more complex. And I would say that's where ratios are not very satisfactory. They are not very satisfactory. Well, it's quite interesting to understand what is the weight of inventory compared to total sales or total cost of sales. But after that, if you say, okay, it's going up, it's going on, you need explanations. And the explanation is not global at the level of inventory. It is at least in one of the four categories you can find. And what category can you find? The first one is what you buy outside. It means mainly raw material, or some services, but mainly raw material if you produce and sell. The second one is the final products. Okay. Third one, it's more complex. It's what's happened between the raw material and the final product. All these intermediate, I will not say, let's say, products or steps. What's happened there? And this is where very often problem is, because it's very difficult to have any clear and acceptable measure. And last, and it's not here in that slide, it is the activity which is trading activity. I mean, you are a producer, but you want to offer to your customer a larger portfolio of products than the portfolio of products you make by yourself. You are in the cosmetics, and you have customers asking for, let's say, 6 or 7 categories of products, and you produce only 3 or 4 of them. What do? You want to give your customer, because your competitors are offering a larger portfolio of products, then what you do is you buy products from our firms in order to have a portfolio, to show a portfolio of products which is asked by your customer. That means you have a business which is on one side a production and sale business, classical production and commercial company, but on the other side you have kind of commercial, pure trading business. And of course, generally you get inventory coming from this, or part of inventory is coming from this activity. So you find 4 different categories. The first one being the category with the services perhaps you buy outside. The second one being final products. The third one, all the intermediate products. And the fourth one, the products the inventory issued from products, final products to buy outside, and you resell to your customer. So you need to work on these 4 different categories if you want to explain like what's happened, to your inventory ratio, inventory as a whole, including all the inventories in the firms. This is particularly important in some economic sector. It is what is written here on point 1. One, and I already said that, I think, if I remember. This is not really important, for example, in an economic sector like the construction sector, and it is mentioned here again in point 5. Why? Because inventories in many construction firms is for about 50% of the total of the balance sheet. That means if you want to explain something on the balance sheet structure, and particularly on the asset structure, you need to explain what's happened inside these 50%. And when you have a look, the largest part of the 50% is generally made of intermediate inventories. It's not raw material, it's not final product, it's not this the trading activities that don't have general trading activity. It's intermediate products. All of these buildings which will be delivered at the end of 2022, perhaps, and they are just working on the first floor, and they expect to have a 20-floor building. What is the value of that? It's quite difficult based on market value, of course. What is even the book value? How do you find it? How do you calculate that? And you have to calculate it when you go over your accounting for a year. It means January and February 21 for situation in December 1st of the preceding year, 2020. And of course, if you have not registered during the night of January the 1st, what is the exact situation? You don't know how to evaluate a kind of proxy. And you have several proxies, and at the end, with several proxies for the largest part, the largest category of the assets, you get bias in your calculations and in your diagnosis and in your performance measures. So this is one of the main problems. So I give you a few elements here from 2 to 4, and after that, these partial inventory measures had to be adapted, found, designed for each specific industry. This is what we have. So let's have a look to point 2. Point 2 is some final products, and final products can be explained or followed in percentage of total cost of the firm, final products divided by total cost of the firm, without VAT, which is quite normal because final products in the accounting system are not in sale price, but in total costs. It means the value of the final products in the balance sheet before they are sold, this value doesn't integrate the margin on the customer. Okay, so if you sell for 100, perhaps it is valued for 85 or 90, not for 100. So it's cost-based. This valuation of the final product, it has to be compared to total cost and, of course, without VAT. This could be done 0.2 in percentages. This could be done also as the preceding ratios in terms of days of total sales. Final products divided by total cost multiplied by 365. And again, without VAT. Same explanation we went through for global inventory. After that, you have a question of raw material in percentage of or days of total raw material payments. So the only possibility which is of interest is compare the level of raw material inventory to the total of raw material payments on the at least an average year, in order to understand what is the turnover. Is the turnover increasing, decreasing? So is there an improvement, or are we in a situation we have more and more raw material, not only in absolute value but relative value, staying there and increasing the costs. So that's what you have to remember. First, you need to explain the changes in total inventory, of course, to calculate total inventory percentage or days compared to something global, which could be total cost of goods or total sales. But second, we need more specific element, and more specific element on the 4 categories of inventories we can find, which are, to simplify, raw materials, final products, final products bought from outside, and intermediate products. Those products you are working on, which are not anymore raw material, but not yet final products. Then, of course, when you have long process of production, you have several steps of production and several categories of intermediate products, which make the thing, the evaluation, the diagnosis, more complex. So I said, in fact, here 2 or 3 important things on that. First, for final products, it's quite easy. I would say you can calculate the ratio of final products as it is valued in your accounting system, in your inventories. You find it if you look at the detailed balance sheet, and they are clearly identified without VAT to total costs or to total sales. And you find these 2 data, at least in the US presentation, in the income statement. Okay? You can make the calculation in days, you can make the calculation in percentage, and both are acceptable. Simply, you use different references. That's what you have. For raw material, you have to compare the raw material number you find in the balance sheet, in the details of inventories, to the raw material payments on the average year. And you find them, if you have good and detailed income statements, you find them in the income statement. Okay. For the trading or commercial activity, it means when you resend to your customer, it's quite simple because you get the price paid. So you get the invoice, the price with and without VAT, okay? And you calculate the ratio of the amount of final products bought outside, to total sales of final products brought outside. It's the interpretation and then the difficulties to solve are exactly those of final products which are made inside the firm. After that, you have the case, which is the most difficult one, of intermediate inventories, and you can have several intermediate inventories. For example, products moving from one location to the other, moving from one department to the other, with different, added value on the product at each step. It becomes very difficult. Generally, in the industrial sector, with recurrent processes, I say with recurrent processes, it's important, we are able to find good prices. When it is in the industry with non-recurrent processes, you introduce on the order specific products, for example. Or if you are in an activity like the construction activity, you build apartments, you build offices, and so on. You are in the construction sector. It's also very, very difficult. That's two difficult, very difficult cases. But you have to try to find solution, because very often, it's not a marginal part of the total balance sheet. It could be 10, 15%, sometimes more of the total balance sheet. That means if you make a mistake of 30% on 15%, it's 5% difference, and it can be variable of the net earnings. Can be your final margin. So this is something which has to be solved, but it is difficult to solve. Now let's move to next slide here. The next slide it's more simple. The problem of receivables is not simple, but the problem of inventories. We have a few very classical calculation, and there is nothing new over time here. The first one is the total of the accounts receivable, which is in percentage of total sales. But be very careful here. We are in the case of exceptions in terms of VAT. It is accounts receivable, and accounts receivable are in your balance sheet with VAT included, divided by sales, VAT included. So accounts receivable divided by sales, VAT included in percentage. Okay. The same ratio can show a result in days. Of course, in that case, it's not anymore percentage of sales, VAT included. It is days of sales, VAT included. For example, if you are in the balance sheet 30 of account receivables and the total sales, which is 120 VAT included, you will divide 30 by 120, which is 25%, multiply by 365, and you will get something like 46 or 47 days. But it will be 46 or 47 days of sales VAT included. Okay. This is for the traditional accounts receivables. You have a third measure for the accounts receivable, and it is the turnover. It is the turnover. It's just what we have seen twice at least, and we started the first explanation on the assets, we have the annual sales, VAT included, and you divide by the accounts receivable. And of course, it is like for inventory, it is like for sales. We did that for the sales, we did like for the inventories. You hope to increase this turnover. It means when you increase this turnover, it means that the same level of accounts receivable, you produce more sales and probably more margins. That means also you give less credits at a point in time to your customer. Okay, so that means this reduces the amount of financial resources you need globally to manage the firm. So it's an improvement. There is a limit. Be very careful. There's always a limit to that. And the limit is that if you reduce too much the accounts receivable, there's two ways to reduce accounts receivable. Either you reduce the credit given to the customer, either you improve your internal management. To improve your internal management, it means to be sure the customer pay at the time, in time, according to the contract. That's good management. But if you decide to reduce the credit, for example, which is a tradition in your economic sector, from the 60 days tradition to 30 days, you will improve your turnover. You will improve this ratio. You will reduce the financial resources needed to finance a company, but at the same time, perhaps you will have a drawback. And the drawback will be a number of customers will not follow you, and we will move to your competitors just because there is a difference in terms of credit, and for you in terms of account receivables. So you have to balance between customer relations and an increase of sales or reduction in sales, and on the other side, financial management, which is of course better in the first analysis when you reduce the amount of accounts receivable. So turnover is an interesting measure also, but be very careful with what you decide. Measure both dimensions, the financial one, direct financial one, and the relation with the customers, and try to find the best balance between the different arguments. This is what we find here, and it's, I think, easy to understand. So the last basic one, last basic one is here. It is for payables. The right side of the balance sheet for operating working capital, it's a bit more complex, here, than the left side for receivables. Why is it more complex? Because, we have to take into account the fact we have on this right side of operational debts, we have at the same time the accounts payable. Some accounts payable deals with providers. And these accounts payable are in the accounting system integrating VAT. Okay? But we have to also to take into account the two other categories. The first one is the relations with the staff, workers of the company. It means, all these amounts which are lent, in fact, by the workers. The premium calculated but not paid, the holidays calculated but not paid, and even the wages. If you have root to a situation generally on the 15th of the month, if you pay monthly, that means there is somewhere 15 days credit, which is not so low in firms with a large number of workers. Okay, so you have to take into account these elements, and remember also that if payables are in the accounting system VAT included, there is no VAT on the two other categories. There is no VAT on tax. Don't pay VAT on VAT. And there is no VAT also on the amount which have to be paid, will be paid sometime to the workers who have less premiums or even wages. So we're trying to make a separation, segmentation of these elements, and to deal on the one side with the VAT problem, which is very classical and very well managed by accountants. You know, there's very strict rules and there's nothing to optimize. In fact, well, you can optimize only when you have investments. And the second one is about second problem is about the workers and the staff. It's also, you know, a problem because it's a bit like receivables. If you limit or pay later the premiums, for example, probably it will not be very well accepted by the workers. When you have growth, you have constraints on workload, and it's more and more difficult to buy good and efficient workers. So if you reduce, if you extend the credit on them, of course, they will not be very happy. Huh? If you want to take a popular measure, you have to reduce this credit, but to reduce this credit is also to reduce your operating, the financial resource coming from the operating working capital. So it's like for receivables, you have to balance the arguments pro and con for the workers. Now you have a problem of the accounts payable that you find here, and accounts payable can be basically, you know, measured by three ratios, 1, 2, 3 here, and then it is very similar to the problem we met with receivables. The first element here is accounts payable in percentage of total cost of sales. Accounts payable divided by total cost of sales, VAT input in percentage. With the same problem, either you have an accounting system which allows you to find easily the total cost of sales, or is it is difficult, and you have a problem for your accountants to solve before making the calculation, and you get anyway a percentage. If you have 20 of accounts payable, it means 20 you have to pay some time to your providers, and the cost of sales, which is 100, VAT included, you get 20%. It can be also in days, instead of being in percentages. So it is the same kind of calculation. 20 divided by 100 is 20%, 20% divided by 365, it's about 73 days, and it is 73 days of cost of sales, VAT included. The accounts payable represent 73 days, in that example, of cost of sales, VAT included. Again, one of the probably simpler calculation or result to understand is accounts payable turnover, as we have a turnover on the other side. Okay, and in that case, you can have the same kind of interpretation, you know, as we did for receivables. You know, first examination, we think that the accounts payable should be maximized. Okay, because that means you get credit from your providers, but you have to be careful also because they are not banks, and they want to keep their best customer. Perhaps you are not one of the best customers. Some are bringing the best margin, and they have perhaps a very large number of potential orders, and they will give a privilege, will choose among their customers and satisfy mainly or primarily those with better return for them. So you will find the same question you found with the receivables, particularly in growing economies where resources and capacity of productions are limited by high demand from the customer. Another point which is of interest here is that it is one of the solutions to obtain a low-cost work and increase the portfolio of investments in PV. Each time, you extend your credit on your providers, and it is the same when you reduce your credit on your customer. Okay, you need less financial resources. Okay, or you obtain more financial resources from the providers. You need less financial resources to finance your customer, or you obtain more financial resources from your providers. The main element on these resources is that their cost is very limited. It's not probably completely zero. There is some kind of relation between the price negotiated and the number of days included in the contract for the payment. But anyway, they are generally very small percentage of interest, in fact. Which means that if part of your resources are coming from these processes, from receivables and providers relations, with low costs, that means at the end, your weighted average cost of capital will decrease. Okay? So, a good management of receivables, inventories, and payables has an impact on your weighted average cost of capital. You need less classical loans or even equity to finance the company. And this is the lower cost financial resources you can obtain. So if you reduce your WACC, you know that after the investment decision course, what's happened with the same cash flows produced by the different projects you are running. This means an increase in the portfolio of investment net present value. And if you increase the portfolio of investment net present value, that means at the end, your returns on assets, return on equity, for example, will be higher than expected or than before. So, there's kind of key here, which is an internal key, which is an operational key, based on the improvement of our relations with customers providers with better also management system of the contract with the providers and with customers, and also improvement of the quality of the management of the full different inventories you find in a firm. And this is an internal solution. We can improve your weighted average cost of capital through a decrease in the need for other financial resources, debt, and mainly equity. And this brings to a situation which is a lower weighted average cost of capital, and at the end, an increase in the net present value of the portfolio of investment of the firm and of its performance measured in return, and particularly by return on assets and return on equity. This is what I wanted to show you on these payables we find here. Okay, so I went through, the inventory, receivables, and payables here, which are the last, main elements of ratio analysis, category by category. I will show you during this course. So what I want to do right now, and to do it will be tomorrow. I want to go through an exercise on that, including, main equilibriums, that kind of calculation and analysis, an extension to return on equity and comparison return on equity with best references available, and also point on cash flow, debt capacity, and something on the goals of the CFO. After that, we have the DuPont analysis, which is somewhere behind this exercise here. I have 2 slides on the DuPont, and then we move to the cash flow presentations and to the classical topics for session 5. That's the projects for tomorrow. So if you remember what you did today, and to show you that, and just come back for last minute here on the session 4 slide, which is number 3 in my presentation today for session 4. I went back on the content on session 3, and then operational return, investment return, shareholder returns, valuation returns, financial debt, leverage, debt capacity, a few questions, 2 slides of questions, the operating working capital ratios and exercises, and we are just there between 8 and 9, and tomorrow we start with 9, 10, and 11 before moving to some other topics. So it's time for you now to go to bed, and to have a rest. I wish you a good night, and I will see you tomorrow. Remember that tomorrow it's not an evening session for you, but it will be an afternoon session, which means it will be a morning session for me here in Europe. I hope you will be available in the afternoon as you are in the evening. Generally, you are less tired on Saturdays. Thank you very much, and don't forget to read Burgundy Marceau. Don't forget also to go back to the documents I sent you, the 107 pages course on financial analysis, which was distributed, is very useful. There are slides, easy to read. It's a good extension of my course as chapter 2. Chapter 2 is. Come back also on the preceding examination to have for civil source preceding examination. You can be trained for this preceding examination. I will start also using a biotechnology case. If you can have the biotechnology case close to you tomorrow, it could be useful and accelerate the process of my presentation. Okay. Thank you very much and good night. Goodbye. Goodbye.